senators and representatives, even though on average Republican Party embraces it more, a lot of it's age based. A lot of times you'll see young senators and representatives from both parties be more embraceful of it because it's not a strictly partisan issue. But obviously that can affect regulation, and then also just potential views on trade, tariffs, and currency differentials. I think that's something,
Hmm.
and that's a little bit more wonkish than things like taxing and spending. But I do think that's that the usage of those levers probably increases if we get a Trump win versus a Biden win. Even though actually, to some extent, ever since the prior Trump administration, both sides have been kind of implementing these kind of tariff.
In today's video, Lyn Alden talks about the rise of fiscal dominance and how it will affect markets in a 2024 and beyond. She also goes into detail about Bitcoin as a backup asset, how the election will affect which asset classes will do well over the next 3 to 6 months, and more.
Yeah, so I do think it's a spectrum rather than an on or off switch, and I think that the U.S. Has, I think we arguably entered fiscal dominance in the early ways of measuring it back in say 2017, 2018, more firmly by 2019, and then in this recent push, kind of the early part of 2023. Or even late 2022 is kind of when we re-entered fiscal dominance. Because if you're right on the line, you could go in and out of kind of fiscal dominance versus if you're like say deep into the spectrum of fiscal dominance. And there's a couple ways to look at it. One is just simply that you're running large structural deficits, but the way that I quantify fiscal dominance is to compare the size of those annual deficits to private sector debt issuance. So if I look at, for example, how much net bank loans were added in a given year, or what is that sum plus how much corporate bond issuance on net occurred, and if that total sum of private debt issuance is smaller than the fiscal deficit was in that period, then I generally argue that we're more in fiscal dominance. So for most U.S. history, modern financial history, that private sector debt issuance in a given year would be bigger than deficits. With some brief exceptions, kind of during and shortly after some recessions, not even all recessions, but some recessions. Whereas what we're seeing now is you see that environment even when you're not in a recession, which is kind of a structural fiscal dominance theme. Another way to measure it is to see that the deficit as a percentage of GDP is increasing during an economic expansion, while unemployment is either shrinking or is just low in absolute terms. Because again, then you have something that's very uncommon. If you look at U.S. history, we were not in an environment like that since the Vietnam War, and even then only briefly. Whereas roughly ever since 2017, we've been in a situation where deficits are structurally up as a percentage of GDP, even when unemployment rate is going down or at very low levels. Now, a country like Japan would be further into fiscal dominance. They're kind of way into it, whereas the United States is somewhere. I think we're in it, but we're not like as deep into it. So again, we can kind of have periods where we go in or out of it. Um, and the why it matters now is because for the past 4 decades, the higher and higher public debt to GDP levels were offset by falling interest rates. So interest expense was a fairly manageable part of the mix. But if we bounce off zero interest rates for a while, and we start going even just sideways in interest rates, we no longer have that offset, and so we start to enter a little bit more of this fiscal spiral that's kind of locked in by demographics, and kind of locked in by interest expense. And so it's not something that you can just kind of politicians can easily get together and resolve. It's kind of locked in really hard. And that's another attribute of fiscal dominance compared to just having a fiscal jolt of activity.
Spot Ethereum Exchange Traded Funds, ADS, in the United States lost a net of $13.3 million on their second trading day. This was mostly because of big losses in the Grayscale's Ethereum Trust. 7 of the 8 new Spot Ethereum EGFs saw net inflows on day 2 of trading. The Fidelity Ethereum Fund F and the Bitwise Ethereum EGF Bit had the biggest net inflows, with $74.5 million and $29.6 million, respectively. BlackRock's is shares Ethereum Trust Etha, which had the biggest net inflows of the group on July 2 to 3, only got $17.4 million from investors on July 24. The new ETFs were hurt by another day of selling from the recently converted grayscale Ethereum Trust ETH, which saw 326.50 million in outflows. Institutional investors to purchase Ethereum, however, it imposed a 6-month lockup period on all investments upon its conversion to a spot Ethereum fund on July 22. Investors have been able to sell their Ethereum more easily in the 2 days following its conversion. ETH has witnessed $811 million in outflows, meaning that existing ETH investors have now sold off just over 9% of the funds holdings. The recent Ethereum ETF performance isn't unprecedented. Spot Bitcoin ETF posted cumulative net outflows for 6 out of 10 of their first trading days, with many blaming outflows from the gray Bitcoin Trust ETF. Notably, Ethereum fell more sharply relative to Bitcoin, which only tumbled 2.6%. This is in line with Cow analyst Will Kay's prediction that Ethereum's price could be extremely sensitive to inflows following the launch of the ETF. Grayscale's ETH shed $48.44 million on its first day of trading as a spot Ethereum ETF. However, robust inflows across the other 8 products pushed cumulative net inflow close to $16.6 million.
Permanent, whereas the individual side is not permanent and is set to expire by, I believe, the end of 2025, offhand. And so, depending on election outcomes, it obviously increases the odds of whether or not those kind of tax cuts are going to expire or not, therefore be an effective tax hike, or if they're going to be made permanent or extended for another number of years. Not just the president election, but also just what Congress looks like. In that period of time will affect the likelihood of those tax cuts. So generally, all else being equal, larger deficits and lower taxes are going to keep us more in that kind of fiscal dominance framework. I think either way, we're in fiscal dominance, but then again, it becomes a degree. If we literally have 6% of GDP deficits and then we cut taxes and we don't cut spending, that actually adds fuel to the fire. That's kind of what we did back in that 2017, 2018 period, is that during an economic expansion, we basically did a mild fiscal stimulus. We cut taxes, but we didn't cut
Mhm.
spending. And we could see that replay again in 2025, or at the very least, it kind of keeps that locked in compared to at least a portion of that going away, and being if basically if those do expire, then you have a little touch of austerity. But again, it's within this big context of still fiscal dominance, still running deficits. So around the margins, that's relevant. Um, it's obviously impactful for digital assets, which is interesting because in earlier years, Trump was not in favor
Mhm.
of Bitcoin and many of these other assets. Whereas I think clearly the industry has gotten to a scale where it's relevant for elections. And so, at least in the current election cycle, the Republican Party is framing themselves right into their platform of being kind of a pro this industry, Bitcoin mining, Bitcoin, crypto securities, whatever the case may be. Whereas the current administration has taken a much less favorable view on it. Even though when you look at, say, senators and representatives, even though on average Republican Party embraces it more, a lot of it's age based. A lot of times you'll see young senators and representatives from both parties be more embraceful of it because it's not a strictly partisan issue. But obviously that can affect regulation, and then also just potential views on trade, tariffs, and currency differentials. I think that's something,
Mhm.
and that's a little bit more wonkish than things like taxing and spending, but I do think that's that the usage of those levers probably increases if we get a Trump win versus a Biden win. Even though actually, to some extent, ever since the prior Trump administration, both sides have been kind of implementing these kind of tariff and kind of currency things. But I think we could see a little bit bigger of an approach in a
Mhm.
second Trump term. Countries as a reserve asset would hold gold, and they issue currency against the gold, and they either back it directly by gold, or they at least use that as kind of a source of strength should that currency weaken. They could technically sell gold and buy back some of their currency. Now, in the modern era, the U.S. Treasury security has kind of replaced gold as kind of the heart of the reserve asset system, although technically there's a variety of different assets you can use as reserve assets. Pretty much any sort of currency, bonds, stocks, and gold. Most of that's liquid except for gold, which, depending on where you store it, could take longer to dispose of. Basically, and that allows countries to protect their currencies during times of weakness, or they can kind of do mercantilist policies and purpose to keep their currencies weak so that they have, for example, an edge in manufacturing. And the mechanism behind that is if let's say the dollar's weakening and a country is running a current account surplus, so their currency strength.
The instant dump you worried about didn't happen. Any price drop would be likely due to market sentiment, not Ming selling. CryptoQuant founder Kai Youngju wrote in a July 24 X post, after the MGX creditors' repayment, all global time zones have passed to added. I think that's FUD. It always has been. Crypto trader Roman. According to several analysts, the price drop may be influenced by seasonal factors, the spot Ethereum ETF launch, and even political factors. Island Alternative Advisor founder Timothy Peterson linked Bitcoin's underperformance to this time of year. Our research shows a persistent history of underperformance from July 22 to September 22. Bitcoin's seasonal pattern happens later in the year and sets up the frequent October that follows. Peterson added in a July 24 X post, Cambriel Investments founder Charles Edwards said the launch of spot Ethereum exchange-traded funds on July 23 may also be affecting market sentiment. The whole market would have been better if the Ethereum ETF launch wasn't in 2024. Ethereum has been languishing this entire cycle, and now it's muddied the waters at the institutional level with the ETF launch, but overall mood is strong according to the Crypto Fear and Greed Index, which analyzes market sentiment toward Bitcoin. Last week's greed score was 68 sevenths. Subscribe to our channel.